Welcome to Trade Pro. In this video, we're going to discuss how you can avoid trading in ranges. Any trend following trader will tell you their worst enemy is a ranging period, as it essentially makes their trend following strategy completely useless. So what are some ways that you can stay out of trading ranges and avoid taking losses? Well, first, I'm going to cover a few different ways that are a little bit subjective, but they are what I personally use. And then we'll go over an indicator that will give you a more exact and objective approach to avoid a range. So let's get into it, starting with a few things that you can do that are a little bit subjective, but I find to be very helpful and effective in avoiding ranging markets. Let's get into it. The first few ways that you can avoid a ranging market all include using the 200 period exponential moving average like I have on the chart right now. The first way that you can use this is by checking the slope of the EMA. If the slope is very steep, then price is likely in a strong trend. If the slope is sideways, horizontal, kind of fluctuating up and down gently, then price is likely in a range. So this is one thing that you can use to determine the strength of a trend and if price is ranging. Another thing you can do with the 200 EMA is check how far price is pulling off of the 200 EMA. So what I mean is, do you see price making a strong move far away from the 200 EMA and staying off of the 200 EMA for an extended period of time? You also want to view, is the price reacting to the 200 EMA kind of like it's repelling against it, or kind of finding a resistance at the 200 period exponential moving average. So for example, if price were to pull close to the 200 EMA or touch it, is it spending a lot of time right over the 200 EMA? Is it coming up over the 200 EMA, chopping around on top of it, or is it repelling from it quickly and swiftly? You want to see that price is repelling off of the 200 EMA, and that is going to be a good indication price is in a strong trend. When price is trading directly over and on top of the 200 EMA, that's a good sign that price is in a range. So you can see here on euro against the US dollar, price has been ranging for an extremely long period of time now, and it's just been chopping directly up and down on top of the 200 EMA with no strong directional bias. While over here we saw a strong trending period where price pulled far away from the EMA and sort of repelled against it. But when price finally did come up over the 200 EMA, start chopping directly on top of it with no continuation, that's when we knew price was in a range. And, one of the ways that you can, really use this to your advantage is by having options. So what I mean by options is trading multiple pairs so that you don't need to be stuck trying to look for trades on euro against the US dollar. So for my Patreon page, I make twice weekly market updates where I cover a few different pairs. And I just want to talk about this because I have advised them to not trade euro against the US dollar, and I've told them which pairs are looking a lot better to trade for the last few weeks. So just to show you guys an example of the pairs that have been really good to trade while euro against the US dollar has been in a range, let's take a look at what I have been trading and what I have been recommending in my market reports. So British pound against the Japanese yen. This has been a clear winner. We take a look at it, and price has pulled significantly off of the 200 EMA for an extended period of time, and ever since this came up over the 200 EMA, got extended far over it and created hidden bullish divergence. I've been talking about buying every single dip along the way until this thing crumbles below the 200 EMA. And we see it again. It touches the 200 EMA briefly here and quickly recovers and rejects off of it, repelling from the 200 EMA, which is what we want to see if we're expecting trend continuation. So that is the expectation here, is trend continuation. As we see, this has been behaving really nicely. So another example of a good trend, something you want to be trading while euro against the US dollar has been, just ranging for all this time. This one here as well. we see price kind of just floats and hovers above the 200 EMA, giving some distance between it. And again, on this downtrend, we see that distance being put between the 200 EMA and the price, which gives us a good indication of the strong trend, along with that slope, looking for that slope of the 200 EMA to give us a good trend direction. Bitcoin has been another one that I have been looking at trading, as it's been behaving really nicely with the 200 EMA. You can see even over here, when we get a bit of a trend change for the short term, it still behaves well with the 200 EMA, swiftly rejecting off it when it gets close. And again, down here, we don't spend much time on top of the 200 EMA, as it is kind of putting a distance between itself and the 200 EMA. So just some examples of what I have been trading while euro against the US dollar has been ranging on top of the 200 EMA. And I have actually been saying, do not trade euro against the US dollar until we see clarity with the directional bias. Okay. So just to give some examples of how this works, and it's not just me saying, you can do these things, but then when you try it in reality, it doesn't work. It simply does work as long as you have other options to trade, because you can see the difference in the charts in real time, and know that you have these other pairs that are behaving much better during this period of consolidation on euro against the US dollar. So now that I've covered those few things with the 200 EMA and the ways that I personally do it, there is another way that's much less subjective and purely objective, using an indicator like the ADX. So let's talk about the ADX. Let's pop it up on the screen here and talk about how traders use it. While I don't personally use the ADX, we can kind of cover how people trade using the ADX to avoid ranges and tell them if price is actually trending or not. So typically how it's used is when the ADX is over a certain number, price is considered in a trending environment, and when ADX is under a certain number, it's considered that price is in a range. So those numbers do vary, but typically they're 20, 25, and 30. So let's just go with 25 here, put a horizontal line on here, and take a look at some of these instances where the ADX goes over 25, showing us a strong trend, and when it's under 25, showing us that price is in a range. So ADX goes over 25 here. We can see price is in a strong trend. Comes back under as we get this consolidation sideways, and then goes back over as price starts to trend again. It comes under again and then goes back up over it as price breaks out of the range. So you can see how when price starts to range, ADX goes down under the 25 level, and when it breaks out of that range and starts trending strongly, we get the ADX to go up to a higher number. Let's take a look over here where we get some more choppy periods, and we can compare the ADX readings over here to over here, where you can see that ADX spends a lot more time down below the 25 level in these choppy sideways market conditions, while in the strong trend over here, you can see the ADX spends more time up at these higher numbers, only briefly visiting below 25 before continuing the trend and sending the ADX over the 25 level again. So if you want a more objective and exact approach to filtering out ranges, then something like the ADX is more for you. And if you want something a little more artistic and less objective or more subjective, then I would recommend going with the 200 period exponential moving average approach, using the slope and the price's distance from the EMA to your advantage. And that is what, the EMA approach is what has worked well for me, although there are a lot of traders out there who swear by the ADX as well, although personally it's not something that I use. All right, so those are the different ways that you can filter ranges and try your best to stay out of the choppy periods. Although, as I said at the beginning, there's no way to avoid all the ranges. You will inevitably, take losses on ranges and reversals. It's just, bound to happen. And there's no way to avoid that. So these are just some tactics that you can use to help avoid the ranging periods. And again, what I was saying earlier with having multiple pairs to trade, and showing some examples with other pairs that have been better performing during this period of range on euro against the US dollar. That's important. You do need to have multiple pairs to trade so that you can use this to your advantage and look elsewhere when the certain pair is not behaving as you would like. So with that all said, I hope that was helpful. Hope you enjoyed the video. I'm going to give a quick shout out to my affiliate Capitalize.ai here. Capitalize allows traders to create and automate their trading strategies just by typing them out in plain English. No coding knowledge required. You can simulate, backtest, and deploy strategies all from your phone, and all for completely free. So check out Capitalize.ai if interested. Thank you.